Hi, I'm Kirk from Tridac Mortgage. I wanted to take a minute to explain why mortgage interest rates are rising even though the Bank of Canada is lowering the key interest rate. Today, March 27, 2020, the Bank of Canada has lowered the key interest rate yet again by 50 basis points. This is the third 50 basis points decrease this month, moving the key interest rate to 0.25%, down from just 1.75% a few short weeks ago. Most of the people I speak with are assuming this means mortgage rates must be at an all-time low. This is not necessarily the truth. To understand this, you must understand the different types of mortgages: variable rate and fixed rate mortgages. The variable rate mortgage, which accounts for 25% of all Canadian mortgages, is driven by the Bank of Canada's key interest rate. Typically, the bank adjusts this rate based on the Canadian economic outlook. If the economy is reporting good news and growth, the rate rises. If it is maintaining a stable view, the rate stays the same. And if bad news or a negative outlook is forecasted, the rate drops. When the bank decreases the prime rate, they are adding money or accessibility to money and therefore encouraging spending, which stimulates economic growth. Today's rate drop should indicate a cut to variable rate mortgages. However, it remains unclear at this time if the lenders will be passing this cut on to the retail prime rate. In recent years, when a variable rate mortgage is obtained, the lenders have been building the rate based on their retail prime rate with a discount subtracted. For example, prime minus 0.9. Several weeks back, prime minus 1 was common to find. However, due to market uncertainty, the discount of 1 has become less common and harder to find. Fixed rate mortgages. Unlike the variable rate, driven by the Bank of Canada's prime interest rate, fixed rate mortgages are controlled by the bond market. The fact that variable rate and fixed rate mortgages are powered by different sources makes it possible that they can do opposite movements on the same day. A few weeks back, the bond market fell to historic all-time lows. Why are we not witnessing all-time historic 5-year fixed rate lows? To understand this, we must understand the bond market as well as the two additional factors influencing fixed rate mortgages today. In a normal economic environment, we probably would have historically low fixed rates. When making fixed mortgage rates, the lenders are more hesitant to move overnight with the bond market and take a week or two to closely monitor bonds before reacting with a rate adjustment. The other factors controlling fixed rate mortgages today are liquidity and mortgage market volume. Liquidity is the amount of money available to be borrowed. Who is willing to lend their money at a 2.09% rate of return? There's fewer investors, therefore decreasing the supply of money. At this time, we have the liquidity, but not as much as normal. Volume. Lenders have seen an increase of volume up to 300% in mortgage applications in Canada because Canadians are worried about their employment. And no employment means no mortgage. The last thing to remember is at renewal, you do not have to re-qualify for a mortgage. If you have any additional questions, please don't hesitate to reach out to me.